Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick reminder, check out the 14-day trial link for StockOracle down in the description. Just a quick affiliate disclosure, we do get a small commission if you sign up to that link, which helps support the show. But remember, we use AI insights and value estimates to guide this, but they can be wrong. So always verify this stuff yourself.
Yeah.
This isn't financial advice. We're here to talk about long-term wealth building.
Right, exactly. Protecting capital while looking for those real growth drivers.
Yeah, protecting capital is key for me. And today, we have a really fascinating setup. We're doing a deep dive into Applied Digital, ticker APLD. And our mission today is really to unpack this massive financial paradox, I guess you'd call it.
Oh, it's completely a paradox. Yeah.
Because it's a company that's right at the center of the whole AI boom, but not in the way that, not the way people usually think about it.
Right, they aren't making the chatbots.
No, exactly. When people say AI, they think software, they think large language models, or they think NVIDIA chips. But Applied Digital, they're the ones building the physical infrastructure.
Concrete, the cooling.
Yeah, the heavy power lines that actually hold all those chips.
Mm-hmm.
So to set the stage for our wealth building thesis here, imagine you're an independent contractor. Right?
Okay.
You build custom homes, you're doing okay. But then, out of nowhere, you win a $36 billion mega project.
Just the contract of a lifetime.
Right. But there's a huge catch.
Yeah.
To actually build this thing, you have to max out your credit cards, you take out 3 mortgages, drain your savings, just to buy the steel and the concrete long before the client actually pays you anything.
So you're incredibly wealthy on paper, but
completely vulnerable in reality.
Yeah, incredibly vulnerable.
And that is exactly where Applied Digital sits right now. They have this multi-billion-dollar backlog, explosive revenue growth, triple digits.
Yeah.
But the stock has just been hammered. The profit margins are deeply negative, and they're sitting on this massive mountain of liabilities.
It's a wild setup, for sure.
So the question for us today is this a durable long-term wealth compounder, or is it just a debt-fueled trap where the carrying costs are going to crush them?
Yeah, and to answer that, we really need to look at the business quality and their fundamentals, because the top-line numbers, they are definitely what draw growth investors in.
Oh, for sure.
If you look at their fiscal year, 2026, their revenue hit $611.3 million.
Wow.
Right. And to put that in context, they were at $228.6 million the year before. So that's a 167% increase year over year.
Which is insane for physical real estate, right? Like, this isn't a software company where you just sell more licenses.
Exactly. Doubling your revenue in 12 months with heavy infrastructure is a huge logistical feat. And their fiscal Q4 of 2026 was even crazier. They pulled in $258.7 million in just 3 months. That's a 407% year-over-year jump.
407%.
Yep.
That trailing 12-month growth is like 364%. But I got to pause here, because as someone who really focuses on valuation and protecting capital, I look at this and I say, okay, the hype isn't just about that $600 million they just made, right?
No, not at all.
It's all anchored to the future. It's anchored to the backlog.
The backlog is the entire cornerstone of the thesis here.
Yeah.
So Applied Digital has secured roughly $36 billion in total lease value.
Which is a staggering number.
It is. The crown jewel is the $7.5 billion deal for a facility they call Delta Forge 1. And then they also have this massive long-term lease with CoreWeave.
Right, and CoreWeave is a huge player now in cloud computing for AI.
Exactly. They specialize in AI workloads, so the demand is very real.
But if I'm an investor, right, I'm trying to figure out how much weight to put on this backlog. Because $36 billion sounds amazing in a press release, but that's not cash in the bank today.
No, it's not.
So how does a multi-billion-dollar lease actually turn into real money for them? Like, mechanically.
Right. That distinction is super important. When they report a $36 billion backlog, that's the contracted lease value over the entire life of those contracts.
Which could be, what, like a decade?
Yeah, 10 to 15 years, usually. They don't get a $36 billion check handed to them up front. The revenue recognition only actually begins when the facility finishes construction, the cooling systems are all tested, and the utility company actually turns on the power feed.
The energization phase.
Yes, energization. And then the client moves their servers in. Only after all of that does the billing start on a monthly basis.
So, okay. Having that backlog proves that companies like CoreWeave desperately want this space. it de-risks the demand side.
Right. They know who the customer is.
But it means Applied Digital has to front all the construction costs today to unlock a revenue stream that's going to trickle in over the next 10 or 15 years.
Precisely. And you have to understand, their emerging growth engine is these AI-specific data centers. And building them is fundamentally different and way more expensive than traditional cloud data centers.
So, like, what's the difference?
Well, historically, you could just pump cold air into a room full of servers, right? Just heavy air conditioning.
Yeah, just big fans.
Exactly. But these new AI chips, the NVIDIA GPUs, they run so intensely hot that air cooling just doesn't cut it anymore.
Oh, I see.
You need highly sophisticated liquid cooling systems. You need reinforced flooring because the server racks are so much heavier. So the capital expenditure per square foot is just immense.
Which perfectly explains the really grim reality of their profitability right now. Because they're bringing in hundreds of millions, but they're just bleeding cash.
Yeah, they are.
I mean, despite doubling that revenue to over $600 million, they posted a net loss of $184.3 million in fiscal year 2026. And I even saw an 8K filing that pegged a net loss for a specific period at like $249.2 million.
Yeah, the exact net loss figure kind of fluctuates depending on non-cash charges and the specific accounting period. But the big picture is undeniable. Their trailing 12-month net margin is negative 42.33%.
So just doing the basic math there, for every dollar they earn in revenue, they're spending about $1.42.
Right.
As someone focused on capital protection, that is a brutal margin. That's a red flag.
It is, but it's also indicative of an infrastructure business in its most intense cash-burning expansion phase. You've got massive depreciation of physical assets. You've got huge interest payments on the debt used to build them. That all runs way ahead of the revenue they can recognize today.
Right.
But if you're looking for long-term growth, you often look past net income at this stage and you look at a different metric. And for Applied Digital, they hit a really critical inflection point with their cash flow.
Right, the operating cash flow.
Right.
Because in fiscal 2026, it finally turned positive. It hit $89.69 million.
Huge swing.
Yeah, from a negative $115.4 million the year prior. And I want to make sure we're really clear on why this is so important. Because the difference between operating cash flow and net income trips people up all the time.
It really does.
So let's use a commercial real estate analogy here. Imagine you're building a massive skyscraper hotel. For the first few years, it is just a money pit.
Just a giant hole in the ground eating cash.
Exactly. And even when you finally finish and open the first 5 floors, your net income for the whole company is still deeply negative because you're paying millions in interest on the billion-dollar mortgage for the whole tower.
Right, that's your net loss.
But the positive operating cash flow means the revenue from the guests staying on those first 5 floors is finally enough to cover the daily operating costs.
The front desk, the cleaning crew.
Exactly. The electricity. The day-to-day business is finally self-sustaining, even if the corporate debt is still massive.
That's a great way to put it. The underlying day-to-day engine is generating cash. And in a heavy capital-intensive industry, that inflection point is a huge milestone. It proves to the market that the basic unit economics actually work.
Right. And to keep building the rest of that hotel, they seem to have secured a massive safety net. Their balance sheet just went through this wild transformation.
Oh, completely.
At the end of fiscal 2025, they had what, like under $44 million in unrestricted cash?
Yeah, around $43.95 million.
And then 1 year later, end of fiscal 2026, that unrestricted cash surged to $1.592 billion.
With a B, yeah.
With a B. And if you include restricted cash for specific projects, it's over $4.1 billion in total cash, which gives them incredible runway. They don't have to keep diluting shareholders to buy steel.
Exactly. It significantly lowers that immediate risk of having to issue new stock just to keep the lights on. But you know how finance works. A massive sudden influx of $1.5 billion in cash doesn't just fall out of the sky.
No, you don't find $1 billion in the couch cushions. They borrowed it.
They did.
And this is where my cautious side really gets anxious, because this is where the math gets genuinely scary. In that exact same 12-month period, their total liabilities skyrocketed from $1.236 billion to $6.186 billion.
A 400% jump.
That's a $5 billion spike in liabilities in 1 year. How does a company even raise $5 billion that fast? I mean, is that just standard bank debt?
No, it's rarely traditional unsecured corporate debt at that scale. The filings point really heavily toward project-level financing.
Okay. Walk us through how that works mechanically.
So when you build a $7.5 billion project like Delta Forge 1, You don't usually borrow that money against the parent company, Applied Digital. You create a separate legal entity just for that building.
Okay.
And then lenders, which are usually big consortiums of banks or infrastructure private equity, they lend the capital to that specific entity. And the loan is secured by the physical asset itself, and more importantly, by the future cash flows from that $36 billion backlog.
Oh, okay. So the banks look at the leases from companies like CoreWeave. They see that legally binding commitment to pay hundreds of millions a year once the building is done, and they use that future promise as the collateral for the loan today.
Exactly. They are lending against the ironclad nature of those leases. And it also includes massive lease obligations for the equipment because, like we talked about, those liquid cooling systems and the heavy generators are insanely expensive.
So they are literally borrowing against future certainty.
Yes.
Which brings us to the biggest threat, the what could go wrong scenario.
Right.
Because borrowing against future certainty assumes the future actually arrives on schedule.
Right.
And building AI data centers, it's not just pouring concrete. The ultimate bottleneck we're seeing across the entire industry right now is the power grid.
Oh, without a doubt. Power is the most critical variable. You have to realize an AI data center does not use power like an office building. It uses power like a heavy industrial steel mill, but it runs 24 hours a day, 7 days a week, never stops.
Yeah, we're talking hundreds of megawatts for one facility.
That's enough to power a small city, all concentrated in one warehouse.
And the reports we have highlight that grid access is becoming super scarce. Why is that suddenly a crisis? I mean, we've had a power grid for 100 years.
Well, there's a couple of massive bottlenecks. First, the supply chain for the electrical gear itself is totally choked. High voltage transformers, the things you need to step down the power from the transmission lines into the data center.
Yeah.
The lead times on those are like 2 to 3 years right now.
You can't just order one on Amazon.
No, you absolutely cannot. And secondly, the local utilities are actually pushing back. If a utility agrees to give 300 megawatts to one data center, they might have to upgrade substations or run totally new transmission lines, which drives up costs for everyday residential ratepayers.
Right. The locals get mad because their electric bill goes up.
Exactly. So zoning boards and utility commissions are heavily scrutinizing these AI projects now.
So let's tie this back to that $6 billion liability mountain. What happens if a local utility says, actually, we need a 2-year environmental study before you can connect to our grid?
Construction stops.
It stops. The building sits empty. You can't start billing CoreWeave. But I assume those banks still want their interest payments on that $6 billion in project debt, right?
They absolutely do. The interest payments, the carrying costs, the lease obligations on the equipment, none of that pauses for a regulatory delay.
It's a ticking clock.
It is. The revenue clock stops, but the debt clock just keeps ticking. And that exact fear, that massive execution risk, is exactly why the stock market is treating them the way they are right now.
Yeah, let's talk about the sentiment and the technicals, because the disconnect between their explosive growth and their stock price is giving retail investors total whiplash.
It really is. I mean, despite blowing out earnings with 400% revenue growth, the stock recently closed at around $26.87.
Which is way down.
Yeah, over the last 13 weeks, it pulled back 37.1%.
A 37% drop in a quarter where they quadrupled their revenue. It defies logic until you factor in that debt clock and the grid risk we just talked about.
Right, and the technical setup is reflecting this heavy skepticism. The stock is currently trading below its 20-day, 50-day, and 200-day simple moving averages.
And when it falls below all three of those, that's just a firm, entrenched downtrend.
The market is in a strict show-me mindset. They aren't giving them any benefit of the doubt.
And it's not just retail or institutional sellers, right? Let's look at the insider sentiment. Because to me, this is one of the most telling metrics for capital protection.
Yeah, insider behavior is crucial. The data shows a monthly sentiment position ratio sitting at a highly negative 96.66. And there have been 0 open market insider purchases recently.
None.
None. But there was a documented open market sale of 75,000 shares by an insider.
Now, let's contextualize that. Because an executive selling 75,000 shares isn't automatically a panic dump, right? They sell for taxes, they buy houses, they diversify.
Sure, yeah.
But the real story to me is the lack of buying. The stock drops 37%, and not a single executive or board member steps in to buy the dip with their own money. That speaks volumes.
It's definitely a cautionary signal. Insiders know exactly what the regulatory hurdles look like and what the cash burn rate is. And you also have to look at the valuation. Over the trailing 12 months, they have a price-to-sales ratio, a PS, of 15.5.
Meaning investors are paying $15.50 for every $1 of revenue.
Right.
And in software, a 15 multiple is high. But you can kind of justify it because software has like 80% gross margins.
Yeah.
Selling another license costs nothing. But Applied Digital is not software. They buy concrete.
Exactly. For a heavy infrastructure company, a 15.5 PS multiple is incredibly demanding. Even after the 37% drop, the market is still pricing in a massive amount of future growth. Investors want to see exactly how they get from a negative 42% net margin to actual profitability.
Okay, so what does that path look like? Let's pivot to the growth thesis. If they navigate the debt, if the power grid connects on time, what is the 3 to 5 year blue sky scenario here?
Well, the blue sky scenario is incredible. It relies entirely on converting that $36 billion backlog into recognized recurring revenue. If facilities like Delta Forge 1 are energized on schedule, all those heavy upfront capital expenditures just drop off.
Right, because once the building is done and the servers are humming, your costs are just maintenance and electricity.
Precisely. Right now, their gross margin is a pretty modest 22.38%. But as those initial costs subside, gross margins could expand into the 35 to 45% range.
Wow.
Which is the historical benchmark for mature data center operators.
So the thesis is they transition from being this cash-burning wild tech startup into essentially a boring, reliable utility company that just prints cash from leasing real estate.
Exactly, and that would totally change their risk profile. Right now, APLD is intensely volatile. They have a beta of 6.07.
Right, and just for anyone listening who doesn't track beta, that just measures how wildly a stock swings compared to the market. So if the S&P goes up 1%, a beta of 6 means APLD theoretically rockets up 6%.
But if the market drops 1%,
it plummets 6%. Yeah. It's a whiplash asset.
Exactly. But in the blue sky scenario, as that volatile construction risk turns into 15 years of predictable monthly lease payments, that beta naturally drops. The market re-rates the stock as a stable infrastructure platform.
And they do have massive optionality and tailwinds. Like NVIDIA. NVIDIA is actually spearheading a $500 billion compute financing platform.
Because NVIDIA knows their chips are totally useless if there are no data centers equipped with power and cooling to run them.
Right. So if that demand stays this hot, Applied Digital's optionality is that they won't just fill this backlog, they'll be able to dictate terms to the market. They become the landlord everyone is desperate for.
The pricing power shifts entirely to them, yeah.
Okay, so to bridge the gap between the scary debt and that beautiful blue sky future, what are the catalysts we should be watching? Let's break it down near, medium, and long term.
Sure. Near term, we need to watch their next earnings reports for sustained sequential revenue growth. They have to prove that 407% jump wasn't just a one-off anomaly.
Okay, medium term.
Medium term is energization announcements. Every single time they put out a PR saying a new facility is connected to the grid and billing has started, it fundamentally de-risks that $36 billion backlog.
It proves the utility companies are actually playing ball.
Right, and long-term, it's about macro regulatory clarity. If we see utility commissions start fast-tracking data center permits nationally, that removes the biggest structural bottleneck to their growth.
All right, so let's get to the wealth building verdict. Based on everything we've looked at, the debt, the backlog, the power constraints, where do we land?
Well, synthesizing everything, our rating is essentially neutral, like a 6 out of 10. The strongest long-term driver is undeniably that $36 billion contracted backlog and the sheer demand for AI infrastructure.
Yeah.
But the biggest threat is the execution risk, the carrying costs on $6 billion in liabilities if they face grid delays.
So the base case is they stumble a bit, maybe get delayed, but eventually muddle through.
The base case is they experience some regulatory delays, margin expansion takes longer than expected, and the stock remains highly volatile as they work through the debt.
And the blue sky case.
Blue sky is flawless execution. Facilities energize on time, gross margins hit 40%, and they re-rate into a highly profitable cash-printing utility.
It's the ultimate high-risk, high-reward infrastructure play.
He really is.
Which brings me to a final thought I want to leave everyone with today. You know, we talk so much about the AI revolution, and it's always about software, generative algorithms, chatbots. It feels weightless, right? Like it's just magic happening in the cloud.
But the cloud is just a physical building sitting on the ground somewhere.
Exactly. The entire software boom is completely bottlenecked by the gritty physical world.
Yeah.
We're talking about pouring thousands of tons of concrete, mining copper wire, and straining local power grids to their breaking point. Applied Digital is basically building the literal mine shafts for the AI gold rush.
Yep.
And if a company with $36 billion in contracts is struggling this hard to build those mine shafts profitably, taking on $6 billion in debt, it raises this massive structural question. Does the limitless infinite potential of AI eventually just slam headfirst into a very physical, real-world wall?
It's the ultimate constraint of our era. It's not just about if we can write better code. It's whether we can physically secure the permits, the concrete, and the baseload power fast enough to actually house it all.
And whether they can pay off the credit cards they used to buy the concrete in the first place. That's going to do it for today's episode. Remember to check out the StockOracle link in the description. Stay disciplined, protect your capital, and we'll catch you next time.